everybody. Luke Gromen, FFTT. Hope you are well. Today is a very big day here. It is Mrs. FFTT and my 25th wedding anniversary. So, very exciting stuff. I'm going to jump right into the questions. As always, thank you for submitting them. Really enjoy the interaction. Very thought-provoking, so thank you. First question is from Eric. What is your take on Judy Shelton's suggestion of U.S. Treasury gold bonds for the long end? In my opinion, her suggestion makes perfect sense, essentially creating long-term bonds that would have some sort of gold convertibility to them in whole or in part. Ultimately, given the debt levels, it would require in all likelihood a much higher dollar price of gold. And so it would amount to a dollar devaluation of sorts. It would go back ultimately when you think about valuation of gold relative to the dollar. It would go back to my point about or metric of U.S. official gold at market price as a percentage of foreign held treasury bonds outstanding. We've highlighted that that percentage is currently around 7%, that in 1989 it was around 20%, long-term average was around 40%, and in an honest-to-goodness dollar crisis, it was about 135% in 1980. So we would need likely at least up 3x in terms of the implied gold valuation, maybe as much as 6x to get back to the long-term average, and of course 19x in an honest-to-goodness dollar crisis. So bottom line is it makes a lot of sense. It would make long-term bonds very attractive by essentially ending the risk of long-term inflation, and as such would serve to reduce long-term borrowing rates for the U.S. government. From Trevor, does your thesis change at all with a Republican or Democrat presidential outcome? How would or would social unrest potentially impact the bigger fiscal dominance Treasury playbook? On the surface, to me, it doesn't matter which of the left or right wins. I think there's some granularity about where deficit-financed industrial policy funds might flow, depending on who wins. But I don't really see a huge change either way. The other thing I think you'd have to watch for is if the Republican side wins, potential tariffs, surcharges, capital controls, things like that in terms of what could be put into place in terms of impacting policy. That's one of these things where you don't know till you know, and then we can react. But from a bigger picture standpoint, austerity's not on the playbook of options unless they really just want to sort of clear the decks and start over. From Liz, Michael Howell said that the stock market is discounted not to the risk-free rate, but to inflation, citing Robert Shiller's data. So if we have fiscal dominance leading to secular inflation, perhaps it's not certain the stock market will rise or rise enough. Can you comment? I agree with Howell's point in a vacuum. However, I think it's important to remember the context and that we're not in a vacuum, which is to say there's a $130 trillion global bond market that will need to run into $65 trillion stock market, which I think is happening. $65 trillion U.S. Equity market, $14 trillion gold market, and $1.3 trillion Bitcoin market for safety from that inflation. And that you're seeing that in the charts. If you look at S&P 500 over TLT, the long bond ETF, it looks like a hockey stick. NASDAQ over TLT, hockey stick. Industrials over TLT, hockey stick. Gold over TLT, all together now, hockey stick. Bitcoin over TLT, hockey stick, but very volatile hockey stick. So my view is in the secular inflation that we are in the early days of. You'll see stocks up in dollar terms, down in gold and Bitcoin terms. Basically, Argentina with U.S. characteristics. From EF, if the IMF or dollar-dominated monetary system were to succeed in stopping the BRICS Plus from moving to a new monetary system, how do you think they would do it? I don't think they'll be able to stop it, but I'm curious how I could be wrong. In my opinion, the linchpin is Russia, because Russia, as long as Russia's willing to accept non-dollars for commodities and in particular energy, there's no stopping the development of the BRICS Plus and the multi-currency gold settlement platform that appears to be picking up speed. Gold net settlement, I should say. So in my opinion, if the US dollar dominated system, IMF, wanted to try to stop this, what would they do? Well, in my opinion, they would start with color revolutions in former USSR republics bordering Russia. Then they might attempt to get those republics into NATO and other Western organizations and kind of pry them away from the periphery of Russia and Russia's influence. They might try to put missiles or arm those states as well. If that didn't work, they wouldn't necessarily be sad if war broke out in those republics. Then that would probably be followed by sanctions on Russia. But critically, it would never oil sanctions. They will not sanction oil because if they sanctioned Russian oil out of the global oil markets, with Russia about 10% of global export markets. You take away 10% of the world's oil out of export markets, oil goes really high, really fast, and that immediately sends long-term inflation expectations really high, really fast in the West, which translate to bond market crash in the West really fast, including treasury bonds. And that is why, in my opinion, despite everything the West has tried to do to Russia, why they have refused to do the obvious, which is they make all their money in energy, but they won't touch energy. That's why. Because if they touch energy, the West will blow up their own bond market in real terms or nominally. Basically, they'd blow up the bond market, and then the Fed / other Western central banks would have to print the money to implement yield curve control, transfer it to currencies and inflation in the West, and they'll be voted out of office very fast. So that is the issue there. What would come next? If proxy war failed, which, oh, by the way, it seems like it is failing along the borders of Russia, the next thing I think they would try would be some sort of economic iron curtain where they try to kind of round up and gather friends of the West against the BRICS. Looks like it's starting to happen. Economically, though, that leaves a group of debtors that don't have a lot of factories and don't have enough energy, but growing young demographics against a group of net creditors of those debtors with lots of factories and plenty of energy and commodities, but bad demographics, generally speaking. Outside of Brazil and places in Africa, the demographics, Russia, China, Southeast Asia, aren't that great. At least as we look at them traditionally. All of this is happening just as we're starting to see or fear or believe, however, that AI and robotics are going to take a lot of young people's jobs globally over the next decade. If that happens, suddenly you're looking at you need to start turning demographics, the traditional view, on its head. Because now you're going to have lots of young people in the West. They're the debtors. They're short of energy and factories, all of which is inflationary if you start putting a curtain around yourself away from your suppliers. And then you get a bunch of AI and robotics taking these people's jobs, these young people's jobs. You're going to have a lot of unemployed, disenfranchised young people in the West. Versus in the East, where you're going to have a lot of robots taking care of old people. And young people protest and riot, and old people, as a rule, don't. So that is a complication that I don't think our leaders are thinking about at all yet, because at least in the West, they tend to not think further than 2 years ahead at most, and more often 2 months ahead. At any rate, the last option, frighteningly, would be some version of World War III, and in my view, it's uninvestable because it would likely quickly go nuclear. Number one, because Russia has said that this is existential for us, and we will use those weapons if our existence is threatened. And number two, Ukraine has just in the last 2 years proven that the West cannot fight an industrial scale conventional war against Russia and China. They don't have the factory base anymore. So the U.S. would likely be in an existential position rather quickly. And so that's completely uninvestable in my view, so I don't want to spend a whole lot of time on it. I would only note that the Russian sub showing up in Cuba recently is probably a bit of a warning sign on that front. It's probably not the only Russian nuke missile sub on this half of the world. So at any rate, something to think about for our leaders that some of whom seem pretty excited about trying to goad some of the BRICS powers into war. Now, the U.S., I think, does possibly have an ace up its sleeve in this case that's not been disclosed, perhaps, of weapons we may have. I mean, look, this whole wrenches cost $200 at the Department of Defense. It's not that wrenches cost $200. It's that wrenches cost $2 from China, and then the other $198 have been deployed into dark projects that hopefully have not been wasted. So, in theory, we've got some stuff up our sleeve. Hopefully that could force a détente and a renegotiation without it getting to the worst case. But I run through this at length because I think it's important to realize we're over 10 years into this process. This isn't, the BRICS just started doing this and we've got another 10 years of runway. Like, we're already at 100 plus knots on the runway, 3/4 of the way down the runway, and the pilot's starting to pull up on the stick because they have escape velocity. And the reaction of the West, I think, is a sign that the escape velocity is near. All right, next question from Alex. Does your outlook, as described in Tree Rings, change if unemployment continues to rise and the U.S. is hit with a labor recession later in 24, early 25? And what will happen or need to happen if the Republican winner deports lots of people in 2025 to secure the economy and prevent fiscal dominance? In my opinion, an employment recession would mean receipts down, treasury issuance up, dollar up, gold up, everything else down at an accelerating pace like you saw in the third quarter of 23 until either the global financial system collapses or more dollar liquidity is supplied via the Fed, via the Treasury, via their proxies, however they do it. I think markets understand this increasingly, and so if there is a recession, you might get a minor bid for long-term treasuries for a moment as traders unwind any positions they have, short-term traders. But then the long-term treasury market would likely sell off in any recession. In other words, rates up in a recession, something most American investors have never seen in their lifetime, certainly. In regards to possible policies of the Republican nominee, I don't know. I don't think he would do something like that, but for sake of argument, anything that reduces labor supplies will increase wages, in my opinion. That increases inflation. That's bad for bonds, and that could force that would force more of that dollar liquidity to keep the treasury market functioning, and as such, probably be good for stocks, gold, Bitcoin, bad for bonds on a real basis. From Gary, Luke, are you at all concerned that fiscal dominance and infrastructure spend have become consensus, putting too many investors on the same side of the boat? I agree that there is some excitement around infrastructure spend. Certainly the multiples on the stocks are high. I agree many more are talking about fiscal dominance, but U.S. 10-year term premiums are still negative. In other words, investors are still not demanding a premium to own 10-year treasury bonds relative to shorter-term paper, which suggests to me that the bond market still thinks the Fed will crush entitlements and crush defense spending to keep positive real bond rates and keep bond investors whole on a real basis. I think there's like no chance of that happening. So that tells me that it's not a crowded trade at all. Also, gold is still a tiny percentage of Western investors' portfolios, as best I can tell from the latest data. And I would also say earlier this year, I was told it's still a fireable offense at a lot of money managers to lose 30% by holding gold. But it's not a fireable offense to lose 30% holding long-term treasuries. And long-term treasuries are down 40-50% from the highs. So that tells me we're still in early days on this whole theme. This is not a year or two thing. By the end of this secular cycle, I think those things will be reversed. I think many more investors will be much more afraid of holding long-term bonds and what the real return is relative to holding gold. From KP, beyond financial preparation, Is there anything you highlight with clients or practice personally in the preparedness realm? Wealth is health. So, number one, what food do you put in your body? Why would you put anything but the very highest quality you can buy, even if you have to skimp on spending in a lot of other places? Food, unlike medication, etc., is the only thing you put in your body 3 to 4 times a day, every single day you're alive. So, number one, whatever you have to do to get the highest quality food, that's what I personally go by, and that's been regardless of what my income level has been in any given year. And I've been on straight commission I've been doing this almost 30 years. I've been on straight commission or a business owner that is effectively straight commission basically that entire time. So there's ups and downs for those of you that have been on straight commission in your lives. It's quite exciting. The second thing I would say in terms of a personal preparation that I follow myself, as geopolitical tensions seemingly keep rising, and as I continue to hear from more doctor friends of mine that pharmaceutical supplies, medical supply chains are dependent to some very real degree on China and imports more broadly, I think it's critical to be in the top physical condition you can be in. It's a big focus of mine. If you need to take pharmaceuticals daily to maintain your health, that's a huge risk that money cannot hedge if supply chains break down. So to me, it's can you run 2 miles without stopping? Can you do 10 plus pull-ups without stopping? Can you do 30 plus push-ups without stopping, etc.? No matter what your age is, it doesn't matter. I just saw RFK Jr. whip off like 20 straight pull-ups at 70. It doesn't matter what your age is. If you can't do those things, that's a risk it's a hedgeable risk, but it's not hedgeable with money, with put options, insurance, whatever. Best way to hedge it: get yourself in shape, eat the highest quality food you can possibly get. From Armin. Goldman recently published a paper arguing foreign holding of U.S. reserves remains buoyant. Data shows it's likely that G7 supporting treasuries versus BRICS replacing that with gold. What is the difference between a commodity-owning nation dropping dollar reserves versus a G7 central bank propping them up? Goes back to my prior point. Right? You've got debtors without factories and without enough energy and commodities, but growing young demographics against creditors with factories and plenty of energy on net, but bad demographics. What does it shake out to? So the debtors are buying the debt of the biggest debtors, the commodity debtors, importantly, especially too, right? So Japan, Europe, they're short commodities, but they run trade surpluses. So they have a little bit relative to the US and UK, which are just massive debtors on a current account basis. So the US and UK need to borrow a lot from Europe and Japan. Europe and Japan don't run that big of current account surpluses. And that assumes that commodity prices stay low, because otherwise Europe and Japan aren't going to lend any money to the UK and any money to the US, because they'll be needing that money. They'll be selling UK bonds, selling treasury bonds to buy commodities from the BRICS, who are taking that money and buying gold. Emptying London, emptying New York to a lesser extent of physical gold. Wash, rinse, repeat. Now you get what we're watching is a snake eating its own tail in the West. Commodities are being levered by Russia and China, as well as China's factories, to force a rebalancing in the system. Debt keeps rising in the West. There is insufficient balance sheet capacity, particularly when commodity prices rise. The West needs to sell treasuries and UK gilts to buy commodities from the BRICS, who take the surpluses and put them in gold, not debt. As that imbalance hits critical tipping points, the Fed, etc., print more dollars or inject dollar liquidity. Fed Treasury proxies inject more dollar liquidity to support their bond markets, which just drives commodity prices up higher, gives more purchasing power to the BRICS makes the commodity imports of the rest of the West higher, not lower. Wash, rinse, repeat. Snake eating its tail. So ultimately, look, gold's up 4x in commodity prices versus commodities since '08. Up 4x versus oil since '08. And I think it's going to keep going higher. Gold's going to keep going up versus oil, versus treasuries. And the reason is very simple. Energy is the base layer to the Western debt-backed system. BRICS can operate without treasuries and dollars. It's painful, but they can operate. If you take away Russia's oil from the West, the entire Western bond market crashes very quickly, and the Western bond market, treasury market, underpins, it's the collateral for the entire Western financialized system. And what wins then? Gold. Who's holding all the gold, buying a lot more of it? Okay. So that's how I'm thinking about it. And to be clear, the West has plenty of gold. If gold goes up a bunch, the West's gold reserves are going to revalue. However, that would imply that treasuries are over as the primary reserve asset of the world. That's a good thing for the U.S. and the world, ultimately. It's just not a good thing for the portion of the U.S. economy that has disproportionately benefited over the past 40 years and so it still has a lot of political power. Washington, D.C., certain interests, and Wall Street, certain interests. Okay, here we go. Next question from GR. Please put some thought around, or some thought context around AI coming too fast, the energy required to run it, and the pace at which the energy infrastructure can be built out, in the lens of a productivity miracle coming too fast or too slow. Thank you. Love your work. Thank you. AI is a productivity miracle. Full stop. So is China in the WTO. So if AI productivity benefits go to the 0.1%, like China and the WTO did, by creating widespread unemployment across the U.S., across a lot of sectors, across the world, just like China going into the WTO did for U.S. employment in manufacturing, then the AI productivity miracle should drive falling tax receipts, rising U.S. unemployment, yawning wealth and income inequality, soaring stock market. Ultimately, it pulls forward the debt and or political crisis, I would say starting in the West more so than in the East, because again, the East's quote-unquote bad demographics are actually really attractive if AI and robotics take a lot of young people's jobs around the world and disenfranchises them. Old people don't riot, young people do. You know who's got the best demographics in the world? The Middle East. Let's see, from Stephen. How would your investment thesis change if you were investing for a USSR-style looting instead of middle-class rebirth? I'm assuming you mean political and elites looting as opposed to something else. It's an interesting question, especially in light of Neil Ferguson this week asking, are we the Soviets? Which, if you haven't tracked that article down, I would. If that's how I was investing, it would probably be more hard assets and less paper claims on hard assets. I'd much rather have a farm than a 401k, and a farm close to me, a farm fully owned, free and clear. I'd also probably focus a lot more on personal supply chains of food, of needed goods, of energy, of personal security, and most importantly, of family and community relationships. People know who you are and how you can help them and how you're willing to help them. If that's what we were heading towards, that's how my views would change. From Max, 3, I guess, to finish up here on with a real estate flair. From Max, would love to hear your take on real estate, especially residential. If trillions of dollars are about to leave bonds, why wouldn't they go into houses? Then from David, Midwestern farmland as investment, being that Midwestern will be is what I've called my favorite emerging market. And then from D, with the devaluing dollar, do you think it makes sense to borrow against real estate assets? So I think we are seeing money flow into houses. And certainly baby boomers, for example, lots of examples of baby boomers buying houses for their kids. You remember, the boomers have $76 trillion in assets and a finite time left on Earth. Look, if I was a boomer and I was really wealthy and my kid needed a house, I'd buy it, full stop. And there's a lot of other boomers who would do the same. Any parent would. I think, ultimately to help them get started, given how inflated home prices have gotten. In terms of houses, I wouldn't broadly say houses. I think it depends on markets. I prefer markets and especially residential assets that have scarcity value and low cost of carry. So lake houses have caught my eye, in part because the lake, everybody loves a lake house. The lake imbues scarcity value like Bitcoin or gold. And lakes because there's no ocean or desert insurance risks. I'm hearing lots of people say out here in flyover country that have places in Florida that are or in South Carolina near the ocean, and they're getting killed with the insurance premiums. And I don't know that that's going to change a whole lot based on the bond losses that insurance companies have taken over the last 3 years. So the cost to carry on a lake house, all else equal, is lower than the cost to carry on a place near an ocean. So I've thought about it that way. And bigger picture, I think it depends on the cash flows of the assets as well. If the cash flows from the asset cover the interest plus an acceptable rate of return in terms of borrowing against it, under even draconian recessionary scenarios, then okay, you could borrow on it. But if not, I really would avoid leverage. I'm avoiding incremental leverage like the plague because I just don't know. Farmland I like a lot. Historically, farmland prices have tracked really well with US M2 money supplies, if I recall correctly, from a chart from my friend Lynn Alden. But again, you got to be really careful with leverage. Farmland by nature is less levered, partly because they still have pretty high, at least they did when I owned 100 acres of farmland, pretty high borrowing loan to value requirements. So I think you had to put like 35% down, if I recall correctly. Mandatory. That was the least you could do, which is a huge difference than the residential housing market around the rest of the country. So don't know if that's still the case. I suspect some version of it still is. So I still like farmland. Plus, it is an actual inflation hedge because the rent you can get from renting it out to farmers varies with actual food and energy related inflation, which is, in my opinion, the only inflation that really matters. So that's it for today. Thank you very much for joining me. As always, if you like these updates, check out FFTT-LLC.com for more information about tree rings and our 10 most interesting things piece in tree, or that is tree rings, I should say. 10 most interesting things, what grabbed us about each thing, whether it's changing or amending or confirming a way we'd previously been thinking about the world. So with that, I'm going to sign off for today. Everybody have a great rest of the week.